Hello everyone, I'm Teacher Ma. Today, I'll discuss the most important of the three accounting statements, the cash flow statement. Why is cash flow so important? It tells your true, imminent story. It determines whether you can open for business tomorrow. This is the most authentic statement because even though we know about assets, which are the balance sheet and the income statement, well, the income statement basically shows your net income, but that's just a surface phenomenon, okay? It's just a theory, because there are so many things you can add or subtract. But the cash flow statement reveals the real facts. In other words, how much cash do you actually have? And can you keep your business running tomorrow? In the three main sections, we have CFO from operations, CFI from investing, and CFF. Without a doubt, the most important is CFO, because operations are the core of a business. They determine whether your business can sustain itself, so CFO is the most important. There is a formula for CFO, which can be called the golden formula. It's arguably the most important formula in all of accounting or modern finance. Whether you're in investment banking or corporate finance, you'll definitely use it. So everyone must remember, CFO equals net income plus depreciation. Add back depreciation and amortization. Subtract the change in operational working capital, because CFO is related to operations. So of course, it has to be tied to operational working capital, right? Now let's calculate it. Based on this formula, assume we have these numbers. So how do we calculate CFO? It's simple. Net income is 135. Depreciation is an add back. Non-cash charges must be added back, as they've been deducted from net income. Okay, in this cash flow, you need to add back depreciation, and then subtract the change in operational working capital. So, comparing year over year, we see accounts receivable increased by 30, inventory, stock increased by 50, and prepaid expenses also increased. Payments have increased by 10. Okay, these are the numbers in current assets that are related to operations. At the same time, what else do we need to subtract? Items related to operations within liabilities. For example, accounts payable increased by 40. Unearned revenue, revenue received in advance, increased by 10. If we use these numbers and do a simple calculation, you'll find the total is 195. This process is intuitive. Why do I say that? For example, if your AR, accounts receivable, increased. What does this mean? Among all your revenue, other things being equal, your cash has decreased because there is too much accounts receivable. Accounts receivable has gone up, which means cash flow has decreased. Similarly, if accounts payable increased by 40, that means accounts payable has gone up. What does that mean? It means the amount you paid out in accounts payable has increased your cash flow. In other words, your cash, other things being equal, increased, right? Because your accounts payable has gone up, you save cash, so you have more cash flow. All of this is intuitive. Now, cash flow from investing. This is something you need to pay attention to. When we talk about investing, we mean fixed asset investment. This means that you are investing in data centers, machines, or factories, or you're expanding. Everyone is searching. So, this calculation is simple. We say equipment sales minus capex. For example, let's say we're building a data center. If the data center costs 200, then it's minus 100. We're assuming no capital gain because equipment sales are 50. Otherwise, we consider the income from that, and CFO would get more complicated. For simplicity, let's assume that when you sell equipment, there's no capital gain. CFF is straightforward. It's about how it's financed. This is simple. If we issue debt, that's 300, and if we repay 100, the amount paid out is all outflow, right? So that's 150. CFF equals inflow minus outflow, which in this case is 150. That's what CFF is for each item. So now we know this one is 195, this one is negative 150, and this one is positive 150. Add them all up, and the total net change is 195. When you add these three together, of course, for simplicity, we're not considering foreign exchange. Our cash, the exchange rates between them, are always the same, no change. So, based on this delta change of cash plus the beginning balance, the cash beginning balance from the same period last year, that gives us the ending balance for this period. Now, how much has our cash increased? This is actually very straightforward. So, that's the end of our calculation, but let's take a look at how these three statements are connected, because that's extremely important. We already know how they're linked, so now let's take a look at that. How do we connect it to the balance sheet? Let's look at the balance sheet. There's a cash amount of 250. For the cash flow statement, the ending balance, we know the net change in cash. We know the beginning balance. So the final ending balance of 250 will match the balance sheet. These have to be compatible. So, how does the cash flow statement connect to the balance sheet? Now, how does the income statement connect to the cash flow statement? That's even simpler. We already know that CFO equals net income plus D&A, right? Minus the change in operating working capital. In other words, these are the working capital items related to operations. In this case, CFO can be directly linked to net income. We've already discussed before that net income flows into equity, okay, as part of retained earnings.